Thank you for joining us on a Saturday morning for our Corporate India result update. We are meeting at a very uncertain time, right? We all know that there's so much happening around us in the world where geopolitical tensions are rising by the minute, and it's pretty uncertain, right? It's as capital allocators, it's always our duty to step back and look at where the data is coming from, right? Because as capital allocators, we are supposed to be reliant on data and not completely on perception. So today, as we always do, we're going to present the Corporate India result update for the Q3 of FY 2025 and 26, where we will be looking at what you need to look at in terms of numbers that have been flowing in from Corporate India. And is today's sentiment going to be a question that we need to keep answering every time the results are going to be keep coming in? That will be addressed in the Q&A session as well, where a couple of questions will be exchanged back and forth within our team. And that's how the presentation is going to go. Now it's going to be presented by Mr. Balaji, GR Balaji, our CIO and co-founder, who's going to be taking you through the Corporate India results. Over to you, Balaji. Thank you.
Okay, thanks, Ganesh. Thanks all for joining. Very good morning on a lovely Saturday. As usual, right, we have been doing this for quite some time on Corporate India, and I think the result season was done. We have reconciled, so we thought we'd just share about the mega trend. And so if you look at the slide is changed, right? So mega trends, we're going to speak a bit of corporate tidbits, what we are picking from corporate in terms of new mode creation and so on and so forth. Third, we're going to look at the numbers, which is basically quarter ending December, right, for 25 and 26, and our positioning, where we are consistently positive, where we have incrementally turned positive, and where we are slightly reduced, right? So these are the things I'll run you through in next 30 minutes or. So the first mega opportunity, right? I'm sure people who have been attending this for quite some time has been seeing this data. The big trend is this India GDP growth, right? So if you look at, we have moved from 38 lakh crores to 100 lakh crores to 357 lakh crores to, in over a period, we are going to be like 1,000 lakh crores, right? So from an investor point of view, there are two important takeaways with this slide. One, we have grown at 10% CAGR for a 24-year period, right? The long period should give you a lot of confidence when people say, right, in the long term, India can deliver double-digit type of an outcome. I think the economy itself is growing for a variety of reasons, but I think the data is real and it's been happening for now, not for 1 year, 2 year, right? This is in the context, the world is growing between 3% types, right? So when the world is doing 3, you are doing 10, which is like a 3 times more growth than the world growth. So when we are bullish, it's a context of we are part of India and predominant our investing is in India. Second, when India has grown from 38 lakh crores to 100 lakh crores, the demand was very, very different to what 100 to 300 lakh crores, right? What it means is when India will pivot from 300 lakh crores to 1,000 lakh crores in next 5-10 years, there is a new industry will flourish. If you think about semiconductor, which was not even spoken 5 years back, defense, something very, very big. I'll share some bit of a nuclear, which was considered to be a taboo types. Now the world is very clear. If you have to power the AI, right, nuclear is the way forward. So I think a lot more new industries will flourish, and that is where, as an investor, the opportunity always lies given the current environment. So moving on to how India's GDP has grown, but how does the market has responded? If you look at very interesting data, 39 years of Sensex and the market return has been given by BSE guys. So if you look at last 39 years, GDP has grown at 12.97, market has delivered 13.4, right? And if you look at last 25 years, GDP has grown at 11.9, markets have delivered 11.58. So one thing is very clear, for a very long period, at least in Indian markets, economic growth is reflecting in market growth. See, this is not a necessary condition in many economy. You have seen China, economy has grown significantly, but the markets have not delivered. They always deliver in spurts. But in India, right, predominantly because Indian growth is led by private, not like a PSU or heavy by government, the private is able to capture the benefit of the growth. And that is where you and I as an investor can participate in this growth and benefit out of this growth. The second interesting trend, if you see, the nominal GDP growth itself is trending downwards. So this is one of the points as an FPS Assets we have been consistently reiterating how to think about long-term return. The 39-year data shows we are close to 13% CAGR GDP growth. But if you look at last 10-year data, it's close to 10%, right? So clearly, as the economy become bigger, right? Today we are a $4 trillion economy. We are not a small economy. The base got catching up. So anybody thinking about long-term return, I think economy is now designed to grow between 10 and 11 from a nominal GDP point. So the large caps can deliver maybe another 2% more from a nominal GDP, and then maybe a small and mid cap, if you buy at right valuation, can do another 2%. So this is a very good mental construct from a thinking about how to think about returns. Going into the next, having seen the GDP growth, how the high frequency indicators are playing out. Inflation is reasonably benign. Rural demand continued to be robust for last 18 to 24 months. Thanks to we had a back-to-back good monsoon. I think it's a little bit of a luck, but I think we have been riding a good monsoon and a reasonable rural growth. Urban is reasonably stabilizing and slightly taking upward. The good news is coming off late is from credit growth. Having seen a very subdued credit growth for a longer period, now we are seeing a credit growth of close to 13 to 14%, which is a good news. As the credit expands, the economy gets a sufficient liquidity from a growth point of view. But obviously, not everything is good. There are a little bit of concern, and one of the concern has been we have been going through slightly elevated trade deficit, primarily due to high import of gold and other metals, which we need to be cognizant. Currently, our current account deficit looks like close to be 1%, but I am sure we have all experienced in the last few days, as Ganesh told, right, with geopolitical tension, oil has spiked. We are importing a lot more materials. So I think we need to be watching this data. And unfortunately, we are not getting a very sustained FIF flow and FDI flow, right, which typically end up matching the CAD. That is why the biggest sufferer of this temporary phenomena is the currency, which has quickly moved from 85. It used to be very stable 8 months to 1 year back, now moved close to 90, right? I think definitely a currency took the toll because of we getting a lesser FDI and FIF flow. At the same time, our trade deficit continued to be slightly elevated, not big, but I think we need to be mindful. But good news is, as I told, the frequency on infra is slowly improving. And I was just looking at this is from an Ultra Tech, a very interesting update on zone wise. They give you how the infra environment is happening, and predominantly green reflects infra is coming back. I'll pick up few interesting things about what type of an infra India is now building. So if you look at North also, right, you can see express highway, you can see typically metro, you can see airport. If you go to Central, again, express highway, airport. If you come to West, if you look at again infra, Mumbai metro, you will start seeing metro. This one, high speed rail is something which is coming up, which is a one more new addition. And South also very similar, right? Airport and metro. So some in substance, we are now moving up the curve in terms of infra, right from expressways, outer ring road, airport, metro, speed rail, right? So clearly the level of infrastructure is good, but the quality of infrastructure growth is also getting better. These are long-term positive, right? Anybody is thinking India from a 5 to 10-year point. I think a better infrastructure gives a flow of goods and service and people at a easier pace, at a lesser friction, which reduces the inflation from a long period point of view and raises the productivity of the entire nation. Now let's see a few corporate tidbits which we picked up during the December quarter, very interestingly. So one of the metric which, as an investor, as a capital allocator, right, we consistently see a lot of corporate talk about new initiatives, but sometimes this new initiative doesn't manifest big. But this is one corporate, this is Eicher Motor, just for an example point that we have taken, has actually taken this new initiative of going into international. So if you look at, right, 2017, the revenue from overseas was close to 200 odd crores. And in 25, it is close to 200,000 crores, right? Really reflecting a 10x growth or 11x growth in a period of, let's say, 8 to 9 year period. And now this is closer to 10%. So one of the things which, when you have to look into any ideas or from a thinking point is, if anybody takes any new initiative, over a 5 to 10 year period, it should become a little more material to move the needle. I think this is one such a nice example to demonstrate how iShare has done well, and obviously stock has also done well. Coming to the next interesting tidbit from HUL, what caught my attention is this line, right? Investing to build future moat, which is quick commerce. So, quick commerce is here to stay. The legend or the largest player in FMCG, the behemoth, is clearly calling out you need to build the future moat, and it is quick commerce. I think these are interesting times, obviously, with quick commerce coming in for FMCG company, which had a strong moat using modern trade, has to now get weakened. That's why we are clearly seeing most of the stocks are trading in the lower quartile in terms of valuations. The third thing, very interesting data from corporate PPT, right? We have scanned the entire close to 200 odd PPTs, and this is all about Nifty company to reflect the mega opportunity from a long term. One is the cement industry. This is from again Grasim. So one of the questions keep coming up, how big certain industry can become. And I think there's a beautiful data where global cement production data has been given here, where 51.1% of the entire aggregate production coming out of China, clearly reflecting the infra-led growth. And India is close to 11%. So India is number two in terms of the capacity. That's point number one. If you look at the right side, China consumes 1340 tons, right, in terms of per capita consumption of cement vis-a-vis we are 300, reflecting if we choose to grow a little similar to China. I don't think we're going the same way, but something similar because of vast population. And I think our biggest bottleneck is the productivity growth, which infra can unlock. I think this number over a period can substantially go, maybe closer to that, not really higher of China, because China took a very concentrated approach, building their entire economy, keeping infra-led growth. But I think the opportunity ahead of is much, much bigger than what most of us anticipate. The third one, AI, I think if there is two topic is now one, the war, second is AI. And this is a very interesting data from HDFC Life, where they have quantified the productivity growth coming out of AI, right? So 40% of the queries are resolved instantly or reduction of time of 30%. So AI is real. Slowly, a lot of corporates are imbibing AI. I think within next 3-4 years, you will clearly see players benefit out of AI, using the technology extremely well, getting a lot of productivity out of the technology. And at similar time, some companies, some industry have to be a little more suffering because obviously, right, every industry goes through a cycle. But this technology is real. It's getting into the corporate, right? So I thought I'll just share about one of the slide, which was very interesting. The next thing about one of the questions keep coming up, what are the big opportunity? And I thought no better slide than L&T, because L&T being a behemoth covers a wide spectrum, right? Apart from EPC. So if you have to look at, I've highlighted four important things which we clearly see is going to be a longest opportunity. Obviously, these things have to be bought in at the right price at the right time. But I think this opportunity is going to be next mega wave, right? One is nuclear. And what is very interesting about nuclear is to put a typical 1 gigawatt of thermal, right? It costs between 6,000 to 8,000 crores. But for nuclear, it will be close to 18,000 crores to 20,000 crores. So one, these are projects which are long term. So typically a thermal project, which is coal lead, takes 5 to 6 years. Nuclear takes between 12 to 14 years. And these are high money intensive. So clearly, when India is going to use nuclear as one of the way to produce power, it's going to create a lot more opportunity across wide spectrum from project gestation period and in terms of the money requirement, right? I'm just giving you some color. If you look at urban mobility, high speed rail is now entering in, right? It's now become real. You will see a lot more. This project will become reality in next 5-10 years, and definitely the material needed for these projects are far, far superior to what the earlier projects. And if you look at, obviously, with war going in, one thing is very, very clear is defense is becoming now more of a national priority rather than whether we need it or we don't need it. And but obviously, right, this is a theme which has been there for quite some time. Most of the stocks are trading at upper end of the valuation. But I think these are mega wave, which I'm sure as an investor, we need to keep in mind. And data center is a thick of the action due to AI. So having spoken about the broad growth about the country and the tidbits about the cement industry, the new emerging sector opportunity, now let's get into and see where are we in the earnings cycle, because I'm sure the last few days and the few weeks has been far more turbulent. Post budget, we got some good news about the trade pact. We felt a little better, and suddenly now the world looks upside down. Globally, also, you're seeing a pattern where the Max 7 is consolidating, the smaller companies or beyond Max 7 is getting growth. Emerging nation is getting really in the, I would say, in the bull market, except the only country is in India. But let's see where the fundamentals are headed and some data to support. The first thing is this is a very interesting, I would say, nine-box quadrant which we have developed and we are consistently use this. This side is something called corporate balance sheet, low, medium, high. Corporate earnings momentum, low, medium, high. So corporate balance sheet, India has continued to be robust, right? We all know the debt to equity for corporate, both at the banking level or at the corporate level, is the lowest in the last 20 years, reflecting the strength of the country and as the companies. But what we lost out the earnings momentum post-COVID recovery, 24, 25, 25, 26 turned out to be a single digit or a lower single digit earnings growth. But the good news is, as quarter three ended also, right, we have entered into double digit. So the broad view is we are going to move from a low earnings momentum to medium earnings momentum. And that is what gives you a better wicket, right? Today, the pain point, one of the biggest pain point of the FI is also the earnings momentum has been pretty slow. To put you in context, NASDAQ index earnings growth is close to 15%, right? And your emerging nation earnings growth is also close to 15%. So when you have a developed nation is also growing at 15, the emerging cyclically also growing at 15, and India, even though it's a long economy, long growth, giving you a 5-6%, right? So from anybody who has a 12 months to 24 months capital, right? This was the capital predominantly went away. But the good news is we are entering into a zone from a low earnings momentum to a medium earnings momentum and not high earnings momentum. The second thing, for the first time in our webinar, right, we have put out this data. This data is coming out from RBI, very interesting data. 3,188 companies, ex-government, ex-financial. So I would say the most difficult corporate rate where it's not government infused or lending infused. This company, how they have fared. So if you were to look at 23-24, the growth rate was close to 5%. And if you have to look at 24-25, 8%. In the last quarter, it's gone to 10%. So clearly, this is what we have been consistently communicating. We hit from a low point, slowly recovering, and now September also was 8 and December was 10, right? So I think growth is coming back. Interestingly, if you have to look at depreciation growth is close to 7%, reflecting corporates are not putting bigger capex. Interest growth is zero, really reflecting the quality of balance sheet, and the operating profit or EBIT growth is close to 13. So from a very low to single digit growth, we are moving to slightly, I would say, not a very, very healthy double digit, but a lower end of the double digit growth has been attained. So I think anybody looking from a medium term, this is one data which we should keep in mind. Growth is coming back. And if you have to look at a couple of interesting trends within these numbers, raw material growth is slightly more reflecting the metal rise. So last 2 years back, with sales growth of 5%, raw material growth was 3. Sales growth of 8%, raw material growth was 6.2. But if you have to look at last 2 quarters, sales growth is 8, raw material growth is 8.7. Last quarter, sales growth is 10 and raw material growth is 12.5. So I think one other thing which we should watch out is the margin pressure because of metals have been rising, currency depreciated. I'm sure auto ancillaries and auto shown some side of margin pressure, right? So clearly this is one thing which we should be watching out. But broadly, the good news is the top line, which is going to be the biggest driver, is coming back at a very moderate pace and not an accelerated pace. So having seen the entire 3,100, right? Now let's get into a specific NSE 500 because we clearly see NSE 500 or BSE 500 captures 95% of the market cap. And it's a very good place to see how these numbers have happened, right? So the first thing is Nifty 50, very consistent with the bigger data, which is 3,000 odd company. Nifty 50 growth, sales growth is 9.2% for the quarter ended December. For the same company, sales growth was 4.9. And if you remove Tata Motors, which has been obviously right, Tata Motors is more of a global play than an India play and having wild swings. The sales growth has moved to 12.5 vis-a-vis 7, right? So clearly the momentum is slightly accelerating. This data is also consistent with 9-month sales. So if you have to look at 9 months sales for Nifty company, it was close to 7. Now it's 9. So one thing is very clear. We are getting the trend up over last year to this year and as well 9 months to this quarter. So one clear message coming out of Q3 is corporate trend is slightly moving in the right direction. In line with the sales growth, the profit growth is also been pretty stable, close to either single high digit, close to 9%, improving. I think what we will expected to see with bank coming back, this number is expected to grow between 13, 14, 15%. But if you look at banking, which is 37% of the index weight, had a negative growth of profit in December quarter close to 10. I think this number will get accelerated with NIM stabilizing, credit growth picking up, asset quality stable. Once this number moves, automatically the aggregate number also moves between 10 and 11, and that is what these large index are designed for. Having seen, so what's the relevance of some sectors? So if you have to look at the last 3 month right profit pool, 35.6% profit pool comes from financials. Energy is the next biggest one. And if you look at consumer staples is 4, IT is 13. So if you have to look at IT, very interestingly, I was looking at one of the data. Today, IT weight is close to 9% in index. Last decade back, it used to be close to 20%. So clearly, you can see some segment of the market has moved from sunrise to sun neutral and possibly a little bit of a decline phase. And some segments are gaining market share, right? So materials, basically, metals is gaining weights because in the last 3-4 years, you have clearly seen post-COVID, metals are gaining weight. So I think we clearly see this is a one phase of the market where active fund manager can play a very good role because there is a change in era. Macro is playing a bigger role, and I think that is where it gets even more interesting from a capital allocation point of view. So having seen the Nifty 50, let's quickly see the Nifty 500, very similar trend. September growth for the sales growth was 5%. And if you have to look at December is 9.6, the trend is improving on 9 month basis also. They're very similar trends. Profit growth, little more better, close to 15%. So one thing is very clear, even though growth is not very high, but it's decent, right? So one thing, anybody looking from a very medium term, I've been consistently telling, right? When corporates, when the funds are growing between 12 to 14%, right, in the long term, I think markets are well designed, provided you end up buying at a reasonable valuation. So I think this is what giving us confidence. Numbers are coming in a very steady manner, not in a very high number, but definitely a healthy double-digit growth is what's seen at an aggregate. Obviously, when you double click and see a disaggregate, some sectors are doing extremely well over the other sectors. So final thing on the earnings, how is the estimates are playing out? So the next year, the estimate is close to 15.7% for the Nifty predominantly. And if you have to look at one sector where as a capital allocator, you have to keep mind is the financial services where consistently the growth is projected to be close to 15%. So with auto and which is consumer discretionary and the financial is going to lead the growth and a bit of supported by the healthcare and the consumption, which is FMCG and IT, right? So these are the 5 top sectors of the market. Clearly, banking has to deliver for the market to deliver what growth has been projected between FY27 and 28, which is roughly 15% CAGR for next 2 years. So having seen the broad trend, titbits and the corporate, what has changed from an allocation of point? Last 18 months been pretty challenged, right? The good news is earnings cut is getting stabilized. As I told, for coming September quarter, the numbers are getting better. The downward trend is getting arrested. So if you see 27 line is getting flattened. So roughly now the estimates are close to 1260 for 2027. So we are close to trading at 20 times 1 year forward in Nifty. Given the current interest rate environment, I would say, right, this is a fair valuation zone. Neither it's too expensive or neither too cheap. So that is where valuation is reasonably palatable. Earnings momentum is slightly picking up. I think the setup is very good. Someone who's starting today, thinking 4 to 5 years, right? I think this data should give you a lot of confidence given the uncertainty in the news flow. The second thing, one more good news is we have seen a very brutal sell-off by FI in 25. I think the first few months it's a mixed bag, but neither we are having big selling, neither big buying. So I think at least one data is very clear. The big selling is not coming in. Last few days could be due to this geopolitical tension. But broadly, the cumulative last 60 days or 40, 45 days, right? It's been broadly neutral rather than any big negative. Domestic money continued to happen, but I think clearly this will be the test case, right? Post COVID, we have hardly seen a correction and volatility. So the mutual fund inflow and the SIP book of 30,000 crores is getting tested. We are hearing that bit of a slowdown is real, and obviously, right, with such a news flow, it's very natural for all of us to slow down. But I think the SIP is very, very long, durable money and can continue to be a little more positive. As I told, the growth primarily for next 2 years is coming from automobile and the banks. Automobile will peak the growth in 27 and then get plateaued close to 15. Bank going to be close to 14 to 15, right? So this is one number which we want to cleanly watch and see how we can allocate capital. So to some extent on the macro, it's a stable domestic macro. Obviously, earnings is stabilizing and recovering, but uncertainty global outlook. So we are not going to get every positive, right? If every positive is there in the news, the asset price will be expensive. So as an investor, we need to be seeing how much long-term news is positive, short-term news is a little more negative. But if asset price is cheap, right, it's a very good starting point to allocate capital to a volatile assets like equity slowly and steadily. The growth initiative taken by policymakers to support the growth, one, we have seen on the RBI rate cut, liquidity, regulation, from the government tax cut and the GST boost, a little bit of regulation downward shift, helping the NBFC to have a good credit growth, which is also getting reflected in a lot of rating business. And finally, government capex is consistently growing close to double digit. So the setup is very clear. 18 months back, quality of the balance sheet is good. That's why we believe this equity bull run going to be longer. Why? Corporate has balance sheet to invest into the business to grow durably. But 18 months back, growth was about to slow down. Valuation was rich. Coming 18 months later, today, March or Feb end, we can see quality of balance sheet continue to be very good. Growth is coming back. I've shared one data about credit growth, which has moved from a single digit to a slightly closer to 13 to 14%. And with now correction coming in, particularly in the small and micro cap, some segment of the market is getting reasonably, I want to say, large cap was always tend to trade at a reasonable valuation. I think now a pocket of the market is also trending, right? So it's not a cheap market, but I think the one leg of a froth is out, and that's where it's turned light green, not a very dark green, right? So ideally, as an investor, you want at least two greens. So if you have to either pay cheap valuation, you will have a slightly bad news, right? So today you have to compromise about taking care of the temporary volatility, but as long as valuation is in your favor, allocating capital to a volatile asset like equity makes a lot more sense than 18 months back. So our positioning, keeping this entire environment about the bigger trend, corporate tidbits, corporate performance, and current macro environment, we are extremely overweight from our broad thinking in terms of flexi cap mutual funds. We are overweight on curated PMS, little bit of thematic. Index weight, we have reduced a bit. We have been very pioneered into index mutual funds. We have been giving a lot more index. But now, given the correction, we think active managers can play a bigger role. Second, with metals and energy playing a bigger role, where typical index weights are close to less than 10%, we clearly see can play. So that's where it's an underweight. SIF is a new asset class. We are ready to distribute. So we are currently at neutral, evaluating a lot more products. Mid cap continue to be underweight. The results have been good. They are growing better, but they are trading at a very rich valuation. Small cap, again, neutral post this correction, but it's very selective. We have also curated something called PMS like mutual fund, where mutual fund operate like PMS, who are very active, high share, where we are very, very positive. So these are the way we are trying to allocate our investors' money given a medium-term requirement and their risk profile. Our conclusion, to summarize, economic cycle is okay, it's getting better. Earning cycle is also going to get better by next 18 months. But I think we have to moderate our risk, right? So I think I've been consistently communicating post-COVID. A lot of portfolios are turned a little more risky than what it is needed, either by segment, having a lot more sectoral funds, or by market segmentation, heavily skewed towards small cap, micro cap. And I think last 18 months have shown us equity tend to be volatile, and it is always volatile, but somehow for a few year period intermediately, we did not see volatility. Now volatility has come back in full force. So I think one of the suggestions which we want to consistently pass on is keep the risk at a very moderate level rather than a very high level. High risk doesn't mean high return. High risk only means higher chance of return, right? So I think once we are very clear about that, we can moderate our risk levels. Third, volatile period like this gives you a very good opportunity to build a future focused portfolio because close to 400, 500 odd companies within the top 1,000 has fallen 30, 40, 50%, right? So clearly, there are segments of funds which are capturing this fall very beautifully. And that's where we clearly see anybody who's allocating money now, giving a 4-year, 5-year outlook, I think possibly they should have a little more better outcome than what somebody came in 2 years back. Sales will be the biggest driver. We are already operating at a very high margin, and with commodity going up, with interest rate now, I don't think we're going to have far more cut. Sales driver will be the biggest driver, which we should consistently watch. And as a FPS assets, we are consistently watching this number and we'll continue to communicate to you. Finally, risk to reward is reasonably favorable in large cap, continue to be there in selective pockets and selective small and micro cap. So these are the areas where we clearly see opportunity exist. To sum and substance, I think our long-term picture is good. Our fundamentals are improving, but today's news flow is extremely tough. Uh, Take a very calibrated approach rather than a very binary way of thinking. Take an incremental decision and come for a long term. I think over the medium term, I think our markets are well positioned to reward investors with the right asset allocation and the right solutions. I think with that, just to end our offerings, we have MF distribution license, SIP distribution, and PMS distribution license. So these are the typical offerings from our end to our investors. And disclaimer: the entire the data and the content is for educational purpose. We continue to communicate on how corporate India has been delivering, and so that we all take a very informed decision. So that's on this one. Um, that's it. Thanks for your time, and we'll be very happy to take any questions if you have. Over to you, Ganesh.
Yeah. Thank you, Balaji. I think a couple of questions from the houses side itself, right? Just, to start off, generally, we always talk about staying long term, right? That's the general thinking of any investor who's new to the market or he's been in the markets. That's what has been projected outside. But when news flow becomes a little bit turbulent, like how it is today, is it very easy to keep your senses stable and then react just to numbers or just to common sense? How easy is it, or generally, or in terms of behavior, how should an investor align himself to just react to data instead of news? Something on that.
Yeah, good question, Ganesh. I think you have to appreciate we are human beings, and today, if I have to step back and think about the biggest problem for all of us, right, including me, is we are overloaded by information, and I think AI has amplified it. So I was talking to one of the specialists of an AI yesterday. I had a dinner meet, and I told what AI brings in and what AI doesn't bring in. He says, Balaji, it simply amplifies things, good or bad, right? It means it comes closer to you very fast. It magnifies things. I think today we are getting more information than what maybe humanly it's possible to process, right? I'm sure all of us will have minimum 100 WhatsApp messages which we have unopened, right? So the trend today is information is flowing. Definitely some part of the world will always suffer, and we have seen historically, right? I think if we think this is something bad, if people would have read the history of 200, 300 years, right? Calamity point or war point, World War One, Two, there are many phases where the friction was part of the life. But I think last 30, 40 years, it got reduced, which is a very great environment. Everybody wished to have very peaceful. But I think COVID led to some changes in terms of, I would say, balance sheet of government. A lot more people are in distress. I think that's where the friction is getting real. So I think getting emotional is part and parcel. But if the long-term objective is to think about the country, how we are operating, what is our fundamentals continue to be robust. So instead of really shutting the case, do incremental, I would suggest, right? Okay, let's say if there is a X rupee of a money to deploy and you're worried, I think it's rightfully there. Don't go whole hog 100, obviously, right? It's emotional. But zero is not a good place. Why? You either get good news or a good asset price. So when the good asset price is happening with the price of fall, you can slowly calibrate, maybe to a comfort, one third of the position you can start. wait for next 10, 15 days, see how the development is happening. It's a little more favorable and the market is recovering, you can go up. It's not recovering, you can stay a little more calm. Watch out. So I would say thinking in probabilistic is a lot more good than thinking in binary terms. That way, you can handle your emotion at the same time, participate in the opportunity. Because if you step back, the biggest opportunity in the last 7 years came from COVID lows, correct? But honestly, to act on one day is very difficult. So I always say you play incremental, right? So you start somewhere, you allow the market to respond, the news flow to respond, and move on rather than being static. So we should get freezed, but at the same time, don't jump tomorrow morning, right? There is no big good news is coming. Good news will take some more time. So I would say calibrated investing makes superb sense today rather than either fully investing tomorrow, by probably no, and zero is also probably a no. I would think that way.
Understood. Thank you, Balaji. A question on the oil prices as well, right? You see a lot of news. I mean, the news is meant to scare you today. That's what the problem is. But then you see the data, it's gone above $90 per barrel. And you see people talking about things like if it sustains above $100 a barrel for, let's say, a 3-4 months period, which is a sustained up move, right? It doesn't bode well for India or generally for the world by itself, which predominantly runs on energy as a source of fuel. So, where do you think this can rattle the entire economy, or to be very specific, India for that matter?
Oh, another good question. I think oil is going to be a pain point. You cannot take away. So to give you some broad number, right, that gives you an idea. We are a 4 trillion economy. We do a import of 800 billion. In that, a very good portion of close to a 200 billion odd dollars is oil at $65, right? So today, the temporary price, I would say at 90, because fundamental doesn't narrate 90, but obviously friction is real. A lot of places, people are not getting in, right? So supply is choked. The demand is constant. So price have risen, which is close to 40%, right? So $180 billion bill going to 40% up, right? It's a close to a 70, 80 billion more you need if it's for a full year accounting. So the question today is oil at 90 is not favorable. That's a given thing. What we don't know is how long it is. If it's going to be a 6 month, yes, it's going to be a lot more pain. And I'll tell you the pain will come from CAD, balance of payment. It will show up in currency, right? Having said that, these are unknown, but I think definitely we need to take as it comes. But today, market knows it's at 90, so the asset will get repriced. That's what I'm telling, right? At 90, the fear is more today. The assets, which is volatile asset like equity, will get repriced, and it's getting repriced every passing day. So at 90, if asset get repriced, let's say war were to end in few months and oil were to come back to normal, which is somewhere close to 60 to 70, right? Asset price will go back. And this is what typically end up happening in the past. But I think these are very fragile environment I think we are speaking in. We need to be a little more careful. Oil at 90 to 100 is not a great place for in India. Definitely, we are a big oil importer. It spikes the inflation. It hurts the lower end of the society. The currency can be a little more volatile because our interest rates are low, right? But you will not going to get again the good news and the good price. I think with this, good price is possible. So anybody can chew the volatility. I think this could be a good window. But yes, oil at 90 for a longer period is definitely negative. But overall, I think the intensity of negativity has come down because we have diversified our energy source. But sudden spike of 65 to 90 is clearly something which I'm sure all the policymakers are watching. And the biggest mandate from the global also is to keep the energy price low. So I think that is where one of the positive narration the world is thinking is with oil at 90, the war should come a little more closer to faster closure because that is not a good place to be in because we lost a lot of money in COVID. Now with this, if people were to suffer, right, I think it's not a great place for all of us, right? So we wish for it, but I think this is a very fluid environment and we need to take as it comes.
Got it, Balaji. Just one last question on, just like a follow-up question on your answer that you had mentioned initially. You said, or pretty much like the summary, right? Don't jump in immediately. There's nothing that's falling apart tomorrow morning or nothing that's falling into place tomorrow morning. So don't jump in. But as asset allocators, we've always seen that relatively a small portion of us has to jump in during a specific time like this, maybe a volatile time. So if I have to jump in as an investor, a portion of me has to jump in today. Where do you think, I have to jump in? Do you think it's in the sub 20,000 crore or sub 10,000 crore category or sub 3,000 crore category where the market carnage has been pretty severe, right? You see stocks have fallen down by 40, 50, 60%. Do you think a bottom-up approach in that case would work brilliantly, at least from a 3 to 4 year perspective? Any views on that?
Yeah, exactly, Ganesh. I think that's what I told, right? There is a change in view from a lower allocation to index and a very curated funds, right? So if you have to look at the lower segment of the market, I would say 5,000 crores subsegment, it's been butchered. I mean, literally, we have seen stocks falling 8-10% with a low liquidity. So typically, these are distress selling, I would say, where there is absence of buyer. So there is actually no big seller. So absence of buyer is pushing the price low. But if you have to see last 20-year history, these are will be a very temporary phase. The asset gets priced to, I am seeing a lot more free cash flow business trading at 2 to 3 price to book, right? Reflecting how distressed this correction has been. But that's where we have curated bit of PMS to allocate capital. But you need to be a little more watchful about volatility will be there. But I think in some pockets, the price is getting a little more attractive with a 4 to 5 year outlook. So I think how I think about this, maybe next 6 months, you might go a little more down, then stabilize. And then you come back very sharply because when the assets are cheap, once you buy in, all you need to give is time. Why? Corporates are delivering between 13 to 15% growth. In 5 years, they will double their EPS. And if there is no PE rating, I think you know, right, where your fair market return. So I think the window is open. You have to be very selective and very calibrated rather than going randomly, correct?
Understood, Balaji. Thank you. I think it makes sense for us to be a little bit more bottom up than ever today, primarily
Yes.
because the correction or the carnage has happened very on a very focused
And
basis, right? We
and
always say
the
that the index is close to its all-time highs, and I mean something on that. Sorry, please go on.
and no, you are right. And this time the macro impact is more. So if you have to look at how you choose your manager who has a macro background, right? All becomes important. That's why I clearly see active managers can do phenomenally good job in next 3 years than what the past cycle. Hopefully they deliver and help all our investors to have a lot more alpha. That's what I'm thinking at least.
Absolutely, absolutely. Thank you, Balaji. I think we have a few questions from our viewers as well. Let's
Sure.
take that one by one. I think the first question is from Mr. Arvind. Thank you, Balaji, for an insightful session. Have two questions. Both China and Japan had economic growth, but that didn't translate to market returns. Apart from private participation, anything else favors India to avoid China-like situation? So that's the first question. And the
Okay.
second question is, do you see a material risk due to an ongoing US-Iran conflict?
So the first question is, if you have to look at Japan, right? Why Japan had a prolonged bear market is primarily the index got very skewed towards banking and real estate, and in China also very similar to real estate, right? So I think whenever your index gets skewed towards one segment and that segment doesn't do well, that's a big risk. So I think one of the myths we consistently want to break is index is not safe. Index is good, index is efficient, but there are times index will become the pain point. I think anybody studied Japan and China very clearly have seen how index has been a pain point, but individual stocks, individual corporates did very well. I think from a India point vis-a-vis China, China growth is primarily driven by government focus, government driven incentive, government protection. Private do participate, but they are always restrictive. If you have to look at India, right, we're lot more liberal, lot more open. And if you have to see the entire aggregate profit pool, the largest profit pool is coming out of our private corporates, and we have a stated policy, good dividend track record. We have a nice protection policy for minority investors, right? Which many country doesn't give. I think our environment is very conducive, very broad based. If you have to look at our sector itself, right, Nifty itself, your 37% is banking, then followed by IT, then followed by auto, then followed by FMCG, then followed by healthcare, metals. It means it's not like your Taiwan or a Korea, a two stock, three stock, 60, 70%. It's a one team. AI team, they do well. No AI team, they don't do well. India is a very diversified team. And if you look at NSE 500, the team is even more diversified. So we are like one type of a US market where every segment is there to participate within the index and within the fund. So I think we are a very different by nature. So this is the point number one. The second question, if this conflict were to go longer, is it a bad? 100% yes. That's not a good news. Why? When the largest nation like US and right? Obviously, some ally support, right, for Iran also can come in. This is an environment which we need to be watchful. And already oil is showing the stress, right? $65 to $90 or 80, $85 on any point in time. Gold is already at a high, clearly reflecting we need to be careful on this environment. But that is what, no, you don't get good environment and good price. So the temporary news flow is weak. So if you have to look at a stock from a DCF point, what does it tell you? The short-term earnings growth will go away. So 1, 2 years earnings growth will go away. But all of us know the biggest value comes from terminal growth. So the question I want to think about is this war a temporary or permanent? If anybody were to take a view, no, this is going to be recurring and permanent, I think then turning bullish on a free cash flow risky assets is not a great place to be in, right? But if you think these wars are temporary, will come down, and it's not something which we envisage to continue, maybe this could be a good window to accumulate a lot more good assets at a favorable price. So the question is, nobody knows when the war will end, right? But oil is at 90. Every policymaker will be getting worried. I'm sure a lot of backdoor conversations will happen to see how they can reduce the tension. And we wish for that to happen sooner than later.
Got it, Balaji. Sir, Mr. Arvind, I think that answered your question. A question from Mr. Mani. When everything is fallen, do we top up PMS or MF or equity stock? All looks attractive. Anything on that? It's a pretty interesting question.
Okay. Fine. First thing, at least we don't have any view on direct equity because currently our current setup is all about distribution of assets. But as you rightly said, things have fallen. I would say it's a specific, right? How much you own what. So we have a guardrails in terms of how much illiquidity asset you should have, how much PMS you have. So I have seen a lot of portfolio very highly skewed towards a lot more PMS than what they're supposed to be, right? PMS is selectively good. Definitely the structure has benefit, but not PMS solves all the problem. Mutual fund has phenomenal solution. Mutual fund has 40-year track record, far more data availability to assess what they say, what they do. So I think about you have to be very specific on what type of a mutual fund you carry. Is your fund as a 240 stock portfolio or a 50 stock portfolio? Is it an index type of a mutual fund or a very curated mutual fund? Is it an high active share, low active share? Is your fund manager overlays macro? Because today the worry is coming out of macro. So your fund manager should be far more experienced, should see multiple cycles, should have a macro overlay, right? So I think the question has to be very nuanced. The easy money of 21, 24 is done, right? Now it's a tough environment. So you have to be very choosy on the fund manager. So the darling of 23, 24, Ganesh, in mutual fund is now in the quartile 4 consistently, right? They're losing AUM, they're losing performance. They have risen to the star and now falling. So clearly you have to be very selective, both on the mutual fund side as well as on the PMS side. Hope I answered your question.
Yes. I think we have another question from Mr. Dileepan Pandithurai. In your view, point of banking and consumption sector on next 2 years growth?
Okay, I think banking should be positive from two things. After a long time, credit growth is coming back, right? So I was just looking at yesterday number. We are like 204 lakh crores credit with 247 lakh crores of deposit. Deposit growing at 11%, credit is growing close to 13 to 14%. Obviously, the worry in the market is deposit is lagging the credit, but definitely credit at this point in time is at 14. And one of the way the banking is going to grow the credit is SBI chairman has given a nice interview about securitization where we're going to recycle a lot of loans to produce new loans. So I think banks will find new ways of growing the balance sheet apart from deposit. But deposit is growing, which should be very positive because if you think everything is constant, no NIM pressure, no asset quality issues, with a 14-15% credit growth, you should get a net interest income growth of 14-15, which we did not see for last few years, right? And banking is a 37% of the index. That's why I think market is a little more confident about the top names will do well. And even if you see the index, Nifty has not fallen big time with such a things happening. Why? The positives are coming in, valuations are palatable. So you have everything ticking, the sentiment is weak. So I think banking is good. Consumption has to be very selective. So if you have to look at Nifty 50, the biggest growth companies are, or the bigger top 200, if you have to write, it is quick commerce companies, your Zomato, Swiggy, your jewelry, Titan did pretty well, your Eicher, Maruti did well. So a pocket of consumption is doing extremely well. A pocket of consumption is doing extremely weak, right? Because of either their industry structure is changing, but I think the government focus is clearly seen in consumption. They are putting a lot more effort on the money. You would have seen the revised GDP estimate. Consumption numbers are revised downward. It means we can expect further policy action in consumption. So we are positive, but consumption is not a, I would say, it's a very stable sector, can give stable return. Definitely, it's not expensive, but it's not very cheap. So you accumulate steadily, but definitely we are a little more positive in consumption also, but we are far more positive in banking at this point in time.
Thank you, Balaji. I think that the number of questions are, yeah. If there are any other questions, please type them out in the chat box and we'll be happy to answer them. Thank you, Mr. Dalipan. Thank you, Mr. Arvind. Any other questions are there? You could type them out in the chat box and we'll be glad to answer them. I think Mr. Sid is typing. I think he has a question.
Any question further, Ganesh?
Yeah, we had one participant typing, but then there's no question yet. We will just give them a few.
Sure.
Yeah. I don't think any questions are coming up. I think we can close the session, but I have one question before we end the session.
Okay.
Balaji. So the thing is, we always keep saying, right? It's always good to be a commentator, but then when you're a player, it becomes a lot different because you're in the game, your skin is in the game. So
Yes.
we see a lot of observations being put on the market, a lot of tweets and posts on the market and what. So do you think you'll have to be a player to actually be a commentator or vice versa? What do you think? Yeah, maybe.
I think, everyone has a freedom to put an expression, definitely. But I think as an individual investor, right, or a participant, I definitely want to see a player doing it because a player knows what is theory and what is practical, what is possible. I'll just give you one example about one of the questions keep coming up in my past role, right? Can you sell this stock and buy back because it's going to fall? Absolutely. I think the question is very valid. When the valuation gets into a little higher zone, you're expected to reduce. But there is a practical dimension from a practitioner point about liquidity, right? So I'm sure we all have seen as an individual, right? If you have to sell a 10 crore and buy back, typically in a lot of stock, the liquidity never exists, right? So you can only buy back when there is a seller, right? So I keep telling you are as good as someone sells, otherwise you're not going to get that liquidity. So there are practical issues comes up. So the thing is, a player can have a little more nuanced view, and obviously, right, they have demonstrated it. And I would always, right, follow a lot more players than a mere commentator. But obviously, right, everyone has the right to share their perspective. Happy to learn from everyone, but I'll be a little more leaning towards who have played the innings long, who have seen through the cycles, who have experienced brutal, and then obviously when they share, it comes from that little bit of ground reality, and that's what maybe right. I will encourage people to follow.
Got it, Balaji. I think that is something that we have demonstrated continuously as a house as well, right? Every other product that we have ideally given to our clients, we've been active participants in those specific products also.
Yes, right.
That's been our practice.
Yes, right. We are now putting our house money when there is a new product, right? So to re-emphasize, as long as we're not convinced, right, we are not going to get into the market. So I think these are small practices which we should do. so that it benefits all of us and gives us a lot more confidence to allocate capital wisely.
Absolutely. Thank you. Thank you so much, Balaji. Thank you,
Thanks.
everyone, for
Thanks
joining
all.
us.